This is the M&A Guy Podcast. I'm your host, Brian Franco. And on this episode, we're going to be talking about building from strategy to exit, specifically building your company that investors can't ignore. I like to say, build a company that's irresistible to investors. And today's guest is a very special guest, Stanislav Zinkov, with a group called Rising Oak Advisory. And we're going to talk about some of the tangible and intangible components of your business and how that's going to equip and position you to really be prepared for these negotiations and these discussions as you pursue growth capital, minority equity partner, majority equity partner, whatever the case may be. So stay tuned, listen in as we dive in. But Stanislav, thank you for joining. Thank you for being a guest here. How are you doing today?
Doing very well. Thank you.
Great to hear. Well, tell us a little bit about Rising Oak Advisory. What was your thesis when you started the company, and where's that led you in your journey as you help clients?
My background is in finance. I was a CFO of 4 KKR controlled companies, public company in Australia, 1 in Japan, 2 in the States. And I have worked for a number of families to help position their companies for sale, in most cases to PE firms. And having sat on both sides of the table, the buy side and the sell side, I realized there's a gap. In some cases, it's a canyon between the performance and perception, and crossing that chasm is where a lot of sellers get a haircut on their valuation. And our focus is to help sellers position their company to come to the negotiations table with a strong confidence in their company's valuation and command the premium, as opposed to come with concessions and negotiate. And we've been very successful in positioning our clients for successful exits. And it's worked out very well.
I love how you frame that, and it really speaks to those that are tuned in, founders, entrepreneurs, looking towards building some sort of capital or partnership for purposes of exit or whatever the case may be. This conversation is going to help you understand what serious buyers and investors are looking for. And Stanislav, you sat on both sides of the table, so have we. But we're going to teach people on how to position their companies to win, because ultimately that's what we all want to do. We all want to win. So, absolutely. Stanislav, when founders are scaling their companies, revenue is a goal. Absolutely, we could all agree there. But how do you position them to win in the settings of bringing on a capital partner or exiting the business at a majority capacity to be part of a larger platform?
So I will say this first: growth breaks companies. And that's an important caveat, because it's not a straight line. And having scaled a number of companies, I know that the challenge is whatever has got you to, let's say, 10 million is not going to get you to 15 million. So you have to retool, and you have to pretty much kill your best work and revisit your best work to make sure that it's aligned to your next goal. And that takes a lot of discipline, and not getting married to your best past performances and what got you there. But I will say this: when it comes to positioning the company where you will get a premium price, we look at it as 2 stages. One is getting the company into continual state of readiness and attractiveness. And when the event comes, to have a transferable, sustainable business value.
Absolutely. So what's the difference? Because let's touch on this, because you hit it right on the head. What's the difference between scaling the revenue of the company versus scaling the enterprise and building the enterprise value? What's the difference? Isn't it the same?
No, I would say so. The former scaling revenue is it's one of the many pieces of the equation, right? But what I've seen more than, and I have Stanford Graduate School of Business has a scaling program where I've been invited to mentor 14 CEOs over the last 8 years. And what I see time and time over is that when it comes to scaling, it's the highlight, right? It's where people pay most of the attention. But you need to position the company to make sure that when you get to that scaling, you have the infrastructure to fulfill the promise to your customers, and have the right people and processes, systems, technology, culture. And that takes a lot of work, and it takes a lot of strategic thought. And then the challenge is that if you don't have the right people, you will you will get to scaling, you will scale, but it can break your company, and the wheels will fly off, and you will end up chasing your tail for a year or two, try to regroup, and I've seen it more times than I care to remember, as I'm sure you have as well.
Yes, we have, because you're talking about quality of revenue. You're talking about alignment with how underwriters and investors are underwriting specifically. But that's exactly what we see in buyers. They pay premiums for predictability.
Yes.
They want predictable revenue stream. They're not just paying the higher valuations for growth. I mean, growth is important, don't get us wrong,
Yes.
but it is predictability. So
Mhm.
when the strategy and the execution aligns, the valuation will follow.
Mhm.
And you see this, I see this all
Yes.
the time. So the punchline here is revenue does not guarantee you a higher enterprise value.
No.
But ultimately, what it comes down to is what's going to enhance your valuation is the predictability of what you built. And that's going to come, as you agree, with with systems, with KPIs, with leadership depth, the whole gamut, right?
Yes.
Is there anything you think I missed in that, or do you think you see it the same way?
I see it the same way, and I see that the buyers do not pay for this upside; they discount what you cannot verify. And that goes back to the proof and a difference between performance and a perception of performance.
Yes.
Because in simple terms, it's EBITDA times the multiple, right? EBITDA is what it is, and you can make it more. You can create a story about a solid story, a narrative around the EBITDA, but at the end of the day, the multiple is the confidence or lack of confidence of continual sustainable revenue and cash that the company will produce based on this revenue. Yeah. So, and I will say this, sellers typically want to focus on selling this story, whereas buyers price the risk. And that's the disconnect between the two.
They price the risk through the data that's provided, and depending on the quality of data, could either support that or discount what that narrative is describing. And that's just it. I mean, if you own a business, you could preserve your EBITDA as is where is, but you could increase the valuation by increasing the multiplier. But multipliers increase by predictability. They don't increase, I should say, by your story or how beautiful you think the business is. And we all think our own businesses are gorgeous, right?
Yes.
But this is where businesses go to get tested.
Mm-hmm.
The private capital markets is not the place to test this. The place to test this is working proactively with systems and companies and advisory firms like Meritage Partners, and of course like your firm, because that's the best place and the best time to test the business and the systems, so that we can provide actionable advice and a directive, so that you can then show up in front of these investors, not only with the narrative, not only with the EBITDA, but the security, with the predictability, all themed around de-risking that investment opportunity. And so if your strategy doesn't align with your numbers, okay, your valuation is going to suffer. And you've seen this, I've seen this more times than we would want to admit, but this is why we have this podcast. This is why we're broadcasting what we're saying, because we want founders and entrepreneurs to be prepared for that moment with those options to win big, and more specifically to access the value that they deserve in their companies. So, with that said, I mean, I want to keep going here, because this is, I feel like I'm talking to myself in a lot of ways here, and I love the way you frame things. But Stanislav, what do you think when you think of those tuned in and listening into you and I talking here? We've talked about strategic alignment and really giving confidence to those investors as they're exploring opportunities. When you see investors evaluating opportunities in the market, you and I both know they're looking beyond the financials, right? What strategic gaps do you see most often that puts companies in a position where they think they're ready for capital, but in reality, they're not? What do you see?
So the way I look at it is, and the numbers are different. About a third of the company's valuation is truly tied to financials, and 2/3 are intangibles. It's a social capital, customer capital, it's operational capital, it's a structural capital, and it's like And can you prove that? Can you verify that? Can you instill a sense of confidence in the buyer that when you hand them over the keys, that it's not going to fold like a cheap lawn chair, and it's going to keep operating and producing cash predictably. And that's where a lot of people miss the boat, is that they focus on financials so much that they miss out on, like, what is the definition of customer capital, or human capital, or like what kind of processes and systems do we have to have in place to continue operating, scaling on this trajectory for the next 2 to 5 years. And it all ties to, so our thesis is that we operate at an intersection of people, finance, and operation strategies. And as a former CFO, I've learned that if I were to come into a company and give them the best financial advice, chances are they're going to put it on a shelf and it's going to collect dust. And the challenge is that in many cases, people do not know how to translate finance into results, or financial strategy into results. So we start with people, we build a financial model, or take what they have and operationalize it and weave it into the company's DNA, and we end with people.
Mm-hmm. Mm-hmm. Well, a lot of what you said there, if like we said, if your strategy does not align with your numbers, your valuation is going to suffer. And there's a few components there that you talked about, different sources of capital, right? But which leads me to, if a founder wants to exit, okay, whether it's a year out, 5 years out, whatever the case may be, or they want to raise capital for, growth over the next few years, what strategic work should they work on immediately? Where's the priority?
That's a great question. And there are two ways I can answer that. First, I would say I look at strategy as internal and external. Internal is that capacity and capability. Can we do this work, and can we do it? Do we have a moat? Can we be like a category king or category queen instead of being commodity, right? We don't want to show up and just be another company that doesn't differentiate itself. You're not going to get a premium for that. And then external strategy is there a market demand, and how do we fit into that market, right? So how do we show up, play to win? And the second way to answer that question is that oftentimes when I'm asked by the business owners, where do I focus my attention? My response is this: what is the one assumption that you believe to be true, that if it turned out to be wrong, it would cause catastrophic damage to a company? Go focus on that. So we expand on that, and we actually focus on like revenue, gross margin, cash, and key employees when it comes to positioning companies for success, a successful exit. And this is part of the getting them to be ready and attractive. And then we focus on what are underlying assumptions that they base the numbers on. So numbers are great, but if the assumptions are wrong, it's not going to work out in the long term. So what are the underlying assumptions? Who owns them? And then and how what are the thresholds? How do you drive the business based on that?
Yeah. We constantly tell clients, because we see this quite often, is the exit readiness doesn't start once you start receiving the LOIs. This is an engineered plan that requires, months, if not years, to prepare for. And it gives clients the optionality to exercise at the moment in time that they believe is that right time. And sometimes that comes from unsolicited offers from investors in the marketplace. Yes. Sometimes that occurs when you're driving a formal process. Or sometimes, there's unforeseeables that could be health, could be burnout, could be partnership split, death, illness. There's a lot of factors that could influence when a company would be sold or exited. But there again, you don't want to be figuring this out when you're in the hospital bed. You don't want to be figuring this out when you're burnt out, right? You want to be engineering this years in advance. And it's complex, but when you understand the rules in which that investors are underwriting by, you can then adhere to those rules. You can't fake this. You and I both know that. But you can certainly position yourself knowing those rules on how to construct a business and then engineer that exit. And that's the biggest difference that we see of those that, win. I mean, everyone can win, but how much are you winning here, right? And so the theme here is founder optionality. That's what we want to founders with. Because if they're working with urgency or because of urgency, it's a bit of a situation of duress and whatever that urgent driver is. But optionality is key. And to have that mindset and really this mindset shift, this paradigm shift of what you and I are describing and discussing, they need to make that today. They don't need to wait, because waiting is ultimately going to negatively impact them when they feel ready, right? I mean, feeling ready, raising your hand is one thing, but being ready is another. What do you think those that are tuned in and listening, what can they do as a top priority to start that journey?
You know, and I think you touched on something that is the key: sense of urgency. Something like 70% of initiatives fail within organizations because there is no sense of urgency. We all wake up and we have a list of 50 things to do and time to do only 20 of them, right? And somebody like Brian or Stanislav comes along and says, let me add one more item to your to-do list. And it's like getting a company to be ready and attractive for opportunities that come next. And it's like, unless you have a sense of urgency, it's not going to happen. So the owner may have a sense of urgency, but they also have to have the follow through to support the team as they evolve, because in many instances, it's nothing short of a culture change. And it's a heavy lift for a lot of organizations, especially if they are family owned and they've been doing this for 20 years and they have kind of like echo chamber, if you will, and then they don't know what they don't know, and then they have somebody like me or you come in and make recommendations that seem daunting, and it may take 2 to 3 years to get to the position where you will get 30% more than you think you would have, or you would have gotten otherwise. Realizing that it takes time, it's not something that can happen in 6 months. My experience, and I've had instances where business owner dies, takes institutional knowledge with him, wife comes in and says, I don't know what to do. And it's a very difficult task to position the company to where an investment bank wants to talk to it, or prospective client wants to take a look at the company. So this is where we focus, like readiness and attractiveness, no matter where you are in your journey, because opportunities come in different forms and you want to be ready. You don't have to accept opportunities, but you want to have an option of turning them down or accepting them. And then when the time comes for you to sell, it's a lot easier process, and you have greater likelihood that you will have transferable, sustainable business value that will be attractive, that somebody is willing to pay a premium for.
Absolutely. Strategy without preparation creates risk. And this is the actual risk perceived by investors as they're underwriting these opportunities and these investments into companies. But again, that preparation without the strategy, it's going to create confusion. And of course, urgency is important. We talked about that. We hit on that. But the winning strategy is those that combine both preparation and the strategy, driven by the urgency. I think you would agree with me on that, right?
Yes.
Yeah.
Organizational whiplash is a real deal, and it's especially a case when like I was it was during COVID, I became a CFO of a family-owned business. They had a portfolio of 7 companies that wanted to position for sale. I was the 5th CFO in 5 years. And when I showed up, people were like, Stanislav, he'll be gone in a year. We don't have to listen to him. And I realized shortly thereafter, there was so much whiplash in that company that any recommendation I made, they were just like, we can't stomach another change. And it's every company is different, but success looks very similar to all companies.
You're exactly right. And it sounds like in that case study you were sharing, the leadership team and the management team was quite fatigued, it sounds like, just by perhaps an overload of information or being given directives that didn't necessarily come to fruition. And that's exhausting for anyone.
Yes.
How did you combat that in that case study?
So winning trust, and it's so going back to why do initiatives fail? One is lack of urgency, right? So you have to create a sense of urgency, and you have to connect the effort to the results and the benefits, and you have to over communicate it, and also you have to focus on small wins, right? Like I cannot come to a team and say we're going to do this, and in 12 months, we're going to get to where we need to be. I want to win in 2 weeks, small win. I want to win in another 2 weeks, and another 2 weeks, and another month. And the wins, they accumulate, the snowball, they build on each other. And then you have a compounding effect of wins, so that when people start trusting you, they start seeing the results, their work quality improves, they see organization moving in the right direction, and they begin to support and buy into your strategy, your initiative, and that was my approach.
Yeah. Yeah. Great approach. Trust is key. Without that trust, it's going to be hard to influence those around you to take the initiatives that you discover and you're working to implement. Stanislav, thanks for being here with us. How do folks get a hold of you?
Rising Oak Advisory. This is the best place to find us. Yeah, get in touch with us. We'd love to hear from you. And then once again, like, our focus is not so much to improve your EBITDA as much as prevent your EBITDA from getting discounted when it matters the most.
Absolutely. Absolutely. Well, we all know that you're tuned in because you are listening to us for advice and guidance because you're building something valuable. And if you want to take what you've built and you want to prepare that, my advice to you is start with clarity. That clarity is going to drive the direction, the directives that you're going to take and initiate it within your company. And the punchline for everyone is strategy without implementation or preparation creates risk. And risk is what's going to deteriorate your value, your multiplier. It may not deteriorate your EBITDA, it'll certainly deteriorate your multiplier, thus decreasing your enterprise value. And that's what we're working so hard every day to avoid. And Stanislav, I do appreciate you and sharing your stories and case studies that I believe resonated with me. I'm sure that's going to resonate with those tuned in and listen. But thank you for being here. And I hope people reach out to you to learn more about your work and how you could assist them. But thank you again.
Thank you for having me.
Yeah, my pleasure. And if you're interested in learning more about our firm Meritage Partners, want to book a discovery call, visit us at meritage-partners.com and be sure to get to your copy of The Inevitable Exit at theinevitable.exit.com. I'm your host, Brian Franco. Look forward to seeing you next week on the M&A Guy Podcast.